Okay. Are you able to hear me?
Yes, sir.
Okay, great. So question number 1, you can read it, number 1A.
Okay, explain the 4 key important dates that existing and the prospective shareholders have to pay attention to when dividends are declared.
Okay, thank you very much. So you need the 4 key important dates, right, that the existing and prospective shareholders have to pay attention to when dividends are declared. Number 1, it is the declaration date. Okay. Let me separate this. Yeah, declaration date, number 1. You have to pay attention to the declaration date. Declaration date. Yeah, very, very important to pay attention to declaration date. So this is basically the date when a company's board of directors announces that it is intending to pay dividend. Okay. On this date, the company declares the amount of the dividend and the payment date and the record date. So on this day, there are 3 things that are announced. Number 1, it is the amount, right? Amount of dividends. How much dividends they are willing to declare as dividends. And the date when they will pay these dividends, the payment date, and the record date, the record date. These are the things that, these are the 3 key things that are announced on the declaration date. So you remember I said that not all profit that has been made has to be declared as what? As profit, as dividends. So yes. I said that some profit has to remain and you plow back, and then the rest you do that. So what about the record date now? That is the second date. Second date, very, very important.
Okay.
What happens on the record date? That is the second date. The record date. Now, on the record date, what happens that this is actually the date on which shareholders must be on the company's books to receive the dividends. So the shareholders must be on the company's books to receive the dividend, or to be entitled to receive a dividend. A shareholder must hold the stock before the record date, okay? Before the record date. So you must hold the shares before that day for you to be entitled to holding. But if you don't have the shares before that day, you have not yet bought them, you are not entitled to those dividends. Okay? There are those people that can still buy the shares after tomorrow, after the record date. Those people will not be part of the dividends. Okay?
Okay.
So they look at those people who had the shares for a long time, even before, those people who had the shares before the record date. The ex-dividend date, very, very important. It's another date. The ex-dividend. The ex-dividend date. So with the ex-dividend date, which is the third one, it is actually the date on which the stock begins trading without the dividend. Okay. So the stock will start beginning to trade without the dividend. So the investors who buy the stock on or after the ex-dividend date are not entitled to receive the declared what? Dividend. That's the ex-dividend date. So there is a day when even if you buy those shares on that day, those shares will not be entitled to those dividends that have been declared. That is called the ex-dividend date. Okay. So if you buy the stock on that day or after that day, you cannot be entitled to those dividends that have been declared. Is that clear?
Yes.
Then the fourth one is the payment date, right? The payment date. So what about the payment date? It is actually the date on which the dividend is actually paid to the shareholders who were on the company's books as of the record date. Okay. Those people on the record date, those people were in the company's books. That simply means they already had the shares or they already had the stock. Okay. On that record date. So the record date is just the day when we are going through the books, checking who is a shareholder. Okay.
Yes.
When did they get these shares? When we're going through, that's the record date. So now, the payment date is the day when we are paying the dividend to all the shareholders who had the shares. Okay.
Yes.
They had the shares and they were in the company's books as of the record date. Is that clear?
Yes, sir.
These are the four key important dates that existing and prospective shareholders have to pay attention to when dividends are declared. Any question?
On the third one, the ex-dividend date.
Yes, sir.
You mentioned to say is the stock that starts, is it before or after the trade?
Okay, so for the exit dividend date, it's actually a day on which the stock begins to trade without the dividend. There will be a day when the stock are the shares. If the shares they start getting sold without the dividends that have been declared already. So you can say, for example, today we have declared the dividends. Maybe after 2 weeks we say we'll have the record date. That is to check how many people are in the books and who have the shares by that time. Then afterwards, you can say after maybe 1 week on such a date, everyone who will buy the shares afterward, they will not be entitled to the dividends. That simply means that if a person buys on that date, the shares that will be sold, they will not be entitled to the dividends until the dividends have been paid, and then they'll be entitled to the dividend maybe next time. You get it, right?
Yes, sir.
Yes, that's about that.
Okay.
Any question?
No, sir. Thank you.
Okay. Then we can look at, you can read question number B then.
The number B says some financial experts have argued that the size of dividends does not matter, as investors can also manufacture homemade dividends according to their preferences. Discuss any four criticism that may be forwarded against this view and support the relevance of dividends.
You've seen that the question was big, it's so compounded, right?
Yes.
Yes, it has a lot of things, but it's good because it will help us to learn much. So what happens is that investors can also make their own dividends according to their preferences. So it is not important how big the dividends are. No. According to financial experts, however, this view has been criticized for the following reasons. The criticisms are as follow. Number one, uncertainty. Right?
And what?
Uncertainty. Uncertainty.
Uncertainty. Okay.
Yes, uncertainty.
Okay.
This is the first view or the first criticism. So now, under this one, investors may not be able to predict future cash flows and may not know how much to pay themselves as a homemade dividend. That is a criticism to the statement. We are criticizing, right?
Yes, yes.
They cannot predict the future cash flows and they cannot know how much to pay themselves as a homemade dividend. So that's why we're criticizing that view, because it is so uncertain we are not certain, investors are not certain, right?
Okay.
And the other criticism is the transaction is hinging around the transaction costs.
Okay.
The transaction costs. So manufacturing homemade dividends can result in transaction costs, which can reduce the overall return on investment. You understand, right? If we can manufacture our own dividends, then there will be transaction costs because the dividends have they come with their own costs. Yeah, there are those transaction costs that you have to incur. So that we can still reduce on the return on the investment. So therefore, we are criticizing the view. So therefore, because of that reason, these guys cannot make their own what? Their own dividends. Taxation is another criticism. Taxation. The homemade dividends are not taxed in the same way as regular dividends, which can result in a higher tax bill for investors. You understand, right?
Yes.
If you make your own dividends, the taxes will be so high because like the normal dividends, the taxes are very, very low. Yes. But for these homemade, like you can really pay a lot of taxes. So as a result of that, we are criticizing that these guys can go to make their own dividends because it's expensive to eat them when it comes to taxes. You got it?
Yes.
The other criticism that we can forward is the time value of money, right? It's from the time value of money. Time value of money. What about this one? What about the time value of money? So the dividends that are paid today are worth more than the dividends paid in the future because of the time value of money. Now, the homemade dividends may not take into account this factor, which can result in lower returns for investors. Yes. So those homemade dividends cannot do that. So what you find is that because of the points that we have just put forward to criticize that view, so we can proudly say that this view is highly criticized. Okay, we can criticize the view. Yeah. The relevance of dividends lies in their ability. We are answering the part which was saying, talk about the relevance. Okay. So the relevance of dividends lies in their ability. Okay. The relevance of dividends lie in their ability to provide regular income stream to investors. They are able to provide regular income scheme to investors, which can be especially important for retirees and those seeking income from their investments. So in addition, the dividends can indicate a company's financial strength and future prospects, which can influence the stock price. They can influence that, okay, the dividends. So because of those points that we have put forward, dividends are also necessary. They're very, very important and we need them. Any question?
It's fine, I've heard.
Okay.
Yes.
You can read question number C. Question 1C.
It says any 5 factors that you think are influencing the dividend policy at any company of your choice.
Okay, so use relevant examples.
Yes.
And discuss any 5 factors that you think are influencing the dividend policy at any company of your choice. So you can just choose any company of your choice. So yeah, in the explanation, I've chosen Coca-Cola Yeah.
Okay.
So, yeah. So for Coca-Cola, there are following factors that affect the dividend policy. To start with, is the profitability. You get it, eh? Profitability. Yes. So you'll understand that when a company earns a higher profit, it can distribute more dividend, isn't it, to shareholders?
Yes. Yeah.
Yes. So you can look at an example of what happened in 2020 for Coca-Cola.
Yes.
Their net worth, because it's a giant company, it's publicized, you get. So it was about 7.6 billion USD, which was a 13% decline compared to the previous year. That was 2019. This decline in profits could lead to a reduction in the dividends paid to our shareholders. So we have to look at, have we progressed in terms of profit? If we have not made more profit, what's the need of declaring more dividends? We injure the business.
Yes.
Right? Any question?
No.
Okay. Great. Then the other key thing, we've talked about profitability. You can talk about, let me write this one. Profitability. And the other one is liquidity. Liquidity. Now, liquidity refers to the rate at which you can convert an asset into cash. Yes, that is liquidity. How fast can you convert that asset? So when you look at Coca-Cola, their liquidity position can also influence their dividend policy. So the company needs to maintain adequate cash reserves to fund their operations, capital expenditure, repaying debt, okay? So if you see that the liquidity of this company reduces, it may reduce their dividends that they declare, because a company will need to be high liquid. It is supposed to be liquid enough. They should have enough cash, all right, so that they can do these, pay these bills, right? Do some capital expenditure, pay some debts, among others. You need the liquidity, you need cash.
Yes.
Then the other factor that influences the dividend policy, it can be growth opportunities, right? Growth opportunities. So with the growth opportunities, using the same example of Coca-Cola, Coca-Cola invests in growth opportunities to sustain its market share and increase its profitability. So if the company has a significant investment opportunity that requires a substantial amount of cash, it may reduce on the dividend payout to fund the investment. You understand, right? So they check. It's the issue of trading off. If we have a better investment that can increase the value of our business and our company, why not getting the money to that opportunity? You get, Ka? We get all our money to that opportunity instead of just keeping the money. So basically, that is what actually happens. Is there any question?
No.
So I have to check if you have got plans to, grow, and again, you check there are opportunities around where you have to invest as a business. Then why giving the money, a lot of money as dividends to the owners? You can just declare a lower level of dividends, and then use the rest and plow back the rest, invest, and so that you can grow the company and increase its profitability and market share in the long run. Okay?
Yes, sir.
Now, the debt is another factor. Debts. These are the things that affect the dividend policy, the factors. Now, the level of debt that Coca-Cola carries on its balance sheet can also impact its dividend policy. So if a company has the high levels of debt, it may reduce its dividend payout to service the debt and avoid crediting rating downgrade. By the way, these PLCs, public limited companies, they are rated, okay? They are rated. We have got serious rating companies where they are rated how much debt they have. So, for example, those that don't even have, if there is any that doesn't have a lot of debt, you find maybe they have A, 3A plus plus.
Okay.
You get it, eh? Then you can also have B plus plus. Okay. Just coming down anyways. So this grading is to grade how highly geared the capital structure of the company is. By the way, gearing simply means how much debt is in the capital structure. So we find that those that have got a lot of debt, we say they're high geared, they have a lot of debt. So because of too much debt, they are graded by some external company. There are some companies that just grade specifically, grade company. They check how much debt is in that company. So if they rate you down, like for example, you have maybe my C plus, C plus. So people know that these guys, they already have a lot of debt. So we can't invest in them because they won't give, obviously they won't give us our dividends because they have to be servicing the debts, right? They will use most of the money to service the debt. So the debt is usually very dangerous because once your company has got too much debt, you will use most of your money just to service the debt. Yeah. So run away from debt. Yeah. Any question?
And so far, so good.
Okay. Now, what about the preferences of the shareholders now? So you find that the Coca-Cola dividend policy is also influenced by the preferences of its shareholders. Some investors prefer dividend income, while others prefer capital gains. Okay. It is a significant number of if a significant number of Coca-Cola guys, shareholders prefer dividend income, then the company may maintain or increase its dividend payout, okay, to keep its inventory happy or to keep the investors happy. So again, you have to check the shareholders' preferences. That is another factor, the fifth one actually. The shareholders' preferences. How are they preferring? There are those shareholders that are interested in getting dividends as income. Then there are those that want capital gain. Those that say you can use all the money and invest in the company so that the company grows in terms of its value. Once its value increases and its market share, what will happen is that more people will come to invest in that company because it's become giant and it makes a lot of profit because they have enough money to fund the project. So as a result, because of a lot of demand of the shares in that company, the price of the share will increase. Now, when the prices of the shares have increased, what it implies is that many people, okay, like a lot of people who had invested in that particular company, who bought the shares at lower prices, they will gain. Okay, they will gain. That is called capital gain. For example, if you bought a share let's use the example for Airtel right now, it's 18 kwacha one share. As for today, so you buy them at 18 kwacha today. Then the value for Airtel has increased such that they're able to sell at 64 kwacha, like their share is now at 64 kwacha, like the ShopRite one. It's at 64 kwacha. So what this means is that these guys, they can you can gain, okay, because when you sell your shares at 64 kwacha each, the one that you bought at 18 kwacha each, you have that gain, okay, in terms of the price. That is what we
Yes.
mean by capital gain. So you find that some customers, some investors, they say, no, us, we just prefer to earn by capital gain, which means if their preference is to earn by capital gain, your focus as a financial manager or as a corporate finance manager is to ensure that the value of the prices has increased. So you invest much in the value of the company. Like you ensure that you make investments that should aim at increasing the value of the company so that the share price can rise.
Yes.
You got it?
Yeah.
But again, on the other hand, if the shareholders, they prefer what? They prefer income, dividend income, then you have to make sure that you declare dividends and give them the income. Because you are working for them. You have to make them happy. That is the most important thing. Any question?
So far, so good.
So in conclusion, we can say the factors that affect it, they are profitability, liquidity, growth opportunity, debt levels, and shareholders' preferences. These are some of the factors that can influence the dividend policy of a company. Therefore, a company has to strike a balance between rewarding shareholders through dividend payout and retaining enough cash to finance their operations and the growth opportunities. You have to strike a balance. I said last time that you don't just wake up and say, okay, I want to declare all the profit dividends. Or we want to get all the money and the plow back. But again, you are waiting for, they won't vote for you next time. So
yes,
yeah, you just have to know how best to to go about this one. Is there any question?
No.
There is no question.
No.
Right. So basically, that is what you do.
Okay.
Yeah. So if you see now, the core topic was just centered around investment. What's this? Dividends. At least by the end of the question, you've gotten some much ideas around the dividends, isn't it?
Yeah. Yes.
You should be fine. Okay. You're going to be very much okay.
Okay.
What about question number 2? Let's look at question number 2 now.
Okay.
The question says, explain the following terms as they apply to international financial management. The current swap, euro currency spot rate, and the translation rate. We start with the currency swaps. Now, a currency swap is an agreement between the two parties to exchange cash flows in different currencies for a specified period of time. Okay? It is just that agreement between the two parties to exchange cash flows in different currencies, okay, for a specific period of time. So what happens is that the currency swaps are commonly used by multinational corporations to manage foreign exchange risk, okay, reduce financing costs and obtain funding in different currencies. That's how you use the currency swaps. It's just swapping the currencies, anyways. You got it?
You said is to what? It's an agreement between the two parties to exchange currencies.
Cash flows in different currencies.
Okay.
So they're exchanging the cash flows, yeah, in different currencies for a specified period of time. Okay.
Currencies.
For a specified period of time.
Okay.
That is what it is. So usually the swaps, I said, are commonly used by international corporations to manage, number one, foreign exchange risk. We use swaps because we are afraid that the exchange rates may actually, maybe the currency might lose value, you know, those things, right? That is the foreign exchange risk. So we are reducing that. We are also reducing the financing costs, and we are trying to obtain funding in different currencies. That's why, as an international corporation, we go for currency swaps.
Okay.
Is that okay? Is that okay?
Yes, sir.
Question number 2 is asking about the euro currencies. What are they in international financial management? So the euro currencies refer to a deposit of a particular currency. It is a deposit of a particular currency in a bank that is outside the country that issues the currency. So it's a deposit of a particular currency in a bank that is outside the country that issues the currency. You got it?
Yes, sir.
So for example, the euro dollar is a deposit that is denominated in USD, okay, in a bank that is outside USA.
Okay.
That's called the euro dollar. And you can denominate in any bank that is outside US. The euro currency markets are major sources of international finance and provide liquidity to global financial markets. We also have got the global financial markets, yes. So the euro currencies provide a lot of liquidity actually. Spot rate. What is a spot rate? Anyway, these terms are properly understood in derivatives. If you are doing international finance, when you do international finance, there is a part at undergrad, you do international finance. Within international finance, they are derivatives. But after undergrad, you can do derivatives as a course, like just the derivatives on their own. So that's why you find such things, currency swaps, the spot rate, among others. Very, very interesting conversations.
Okay.
Now, so a spot rate is the current market price. It is the current market price at which a currency can be bought or sold for immediate delivery. So a spot rate is the current market price at which a currency can be sold or bought for immediate delivery. So usually these spot rates are used for transactions that require immediate settlement. For example, the purchase of goods and services can use the spot rates. The translation risk, number 4. What about the translation risk? So with the translation risk, it is the risk that a multinational corporation financial statements will be negatively affected by changes in exchange rates, especially when translating foreign currency denominated assets and liabilities into the parent company's reporting currency. The translation risk is a risk that a multinational corporation financial statement will be negatively affected by the changes in exchange rates when translating foreign currencies denominated assets and liabilities into the parent company's reporting currency. So the translation risk arises due to fluctuations in the exchange rates between the firm, the time a transaction occurs and the time it is settled. There is that. So you find that there are some fluctuations in exchange rates that can take place in between the time the transaction occurs and the time it is settled. So those are what you call the translation risk. Is that clear?
Yes, sir.
Any question?
No.
But you don't have a question, right?
No, sir.
There is no question. Great. Okay. We can do which one? Switch. Okay.